Good morning, welcome to Morning Markets. Today we're going to focus on what happened last week in terms of financial markets and what the key events for markets will be this week. If we start by reflecting on financial markets last week, we saw some weakness within global equities. Global equities down about 0.9% in sterling terms. For multi-asset investors, what we saw is global government bonds proved to be an effective diversifier as we saw yields fall and prices rise, offsetting some of the losses within equity markets. The reason for the softness within equity markets was a combination of factors. Firstly, we continued to see some softness within US economic data, as well as that tariffs, which is weighing on business confidence, as well as US technology stocks losing some of their momentum that we've seen really for the last 4 to 6 weeks as investors recalibrate their expectations in terms of what they can deliver in terms of earnings and sales, given the emergence of new technology coming out of China with DeepSeek, AI competitor. It's also worth noting that there have been positive returns in some markets, global markets. Thinking about the FTSE 100 here in the UK, we saw FTSE 100 reach a new all-time high on Friday. Thinking to the week ahead in terms of the key events that markets will be focusing on, starting with the US, it'll be about the employment report that comes out on Friday. In terms of the labour markets, we saw a little bit of weakness coming through in January. That was very much due to the cold weather. We've also had some softer economic data over the course of the month. So the markets will be hoping for a stronger reading in terms of the employment data. Expectations are for 158,000 jobs to have been added in February and unemployment to remain firm at that around 4% level. Expectations that the federal job losses, which can be attributed to the Department of Government Efficiency, isn't expected to come through until next month. Elsewhere, we'll be looking at survey data from both the manufacturing and the services sector. The weakness that we saw over the last couple of weeks in US equities can be attributed somewhat to the weakness that we've seen in the services side. Quite unusual because services has continued over the last 2 or 3 years to be the real bedrock of the US economy. So some nervousness that is cooling. So we'll get another reading on that this week. More encouraging has been the manufacturing side, which has showed early signs of improvement. We'll keep an eye out on the prices paid component, which has been ticking higher over the last couple of months. Fears around tariffs may be pushing that higher this week, so we'll be keeping an eye on that given the consequences that has for inflation. Thinking about Europe, the European Central Bank will be meeting on Thursday. Expectations are that they'll cut interest rates again. Looking forward, the market still expects interest rate cuts in addition to this week's for the rest of this year. However, it's becoming a little bit more challenging given the prospect of greater defence spending, but also the ongoing stickiness within some of the inflation components and also just the prospect of tariffs coming through from the US will also challenge the future interest rates. In China, there'll be really kicking off this week will be the National People's Congress. So they will be getting together to determine what their expectations and outlook are for China's economy. Expectations that GDP will remain at around 5% this year, and that's despite prospects of tariffs coming in place from the US. That's all from us today. Thank you for watching, and we'll see you tomorrow.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.